So, what's going on, guys? I did a video earlier this year called a Deflationary Headfake. And in that, I said that we could have what mainstream economists call deflation with falling prices. I define deflation a little differently with the contraction of money supply and credit. But once again, we live in a Keynesian world. If you look at my scenario, deflationary head fake, I talked about China being the precursor to all of this mess. I mean, if you looked at the 7-day repo rate, which I've covered in these videos and in the past, I talked about, hey, China could be the black swan that makes prices fall. And we do see prices falling in the United States when it comes to certain commodities such as oil. If you want to look at natural gas, copper is falling as well. If you want to look at the oil price in general, it's quite interesting. The top was in June, and then all of a sudden, the price is $55 a barrel. Some individuals state that, hey, it was based on the charts. I'm not denying that. But at the same time, I would say some of it has to deal with the coordination by central banks and the Anglo-American establishment to try to punish Russia for getting involved in the Ukraine, Crimea, etc. I think all of it plays together. So if you want to look at this, you see roughly or close to a 50% retracement in the price of oil within a 6-month span, which is a huge move. If you want to look at October 29th, right, the end of QE, I believe. So it went from $80 to $55 a barrel. If you want to do the math, end of October, it's 80 minus 50. So 32 or 31% moves to the downside since QE. Now you have to ask yourself, was some of it priced before the announcement of the end of quantitative easing? If you look at a few years ago, I think many individuals would have been surprised in how the oil prices have fallen down. If there is a geopolitical event, something with Israel, Iran, or the Mideast blows up, yeah, I would expect to see a huge short squeeze. But right now, a lot of individuals are bearish on the price of oil. Now, many individuals are saying that the price of gold was overheated 3 years ago. Those individuals are right. And now it's coming down back to earth, according to these individuals who were once bearish, now slowly but steadily turning bullish on the price of gold. Many individuals would attribute this to deflation or a stronger dollar. As you know, I have covered the price of gold and overlaid it versus the dollar yen or the yen chart. As we know, the yen is depreciating while the dollar is appreciating against the yen. And if you look at it from dollar term, gold has been falling down. Before 2011, what we saw happening was strong appreciation of the yen, where we saw the price of gold at $1,900 an ounce. And then when that yen carry trade started to reverse, right, that's when we started to see the depreciation of the yen and in dollar terms the gold price falling down. So you could say, hey, that's a deflationary aspect. Those individuals who follow the mainstream economics. So if you want to look at right now, the dollar index is 90.1 or 90.2, around that range. And if you want to look at where we were in August of this year, we were at the 79 handle, close to that, or 80 handle, and then it went from 80 to 90 in a straight line here. A lot of it had to deal with the euro, right? The euro depreciated against the dollar while the dollar got stronger. And if you want to look at the dollar yen, right, the yen, as I mentioned before, has weakened against the US dollar index. So as a result, what's happening to this Dixie index? It's going up. And if you guys remember, the dollar index is a basket of fiat-based currencies. It contrasts, or it consists of 57% of the euro approximately, and somewhere around 10 to 11% of the Japanese yen. So if you look at the euro, if the euro has weakness next year, significant weakness, and the yen currency as well, this dollar index is going to go up. It's just all relative, right? We know all of this is bogus, baloney, this and that. But this is how the market perceives it. This phony market, okay? Secondly, if you want to look at all the individuals, they're saying, hey, strong dollar, lower prices, right? We're seeing lower prices once again in oil, gold, copper, this and that. We obviously know that the inflation rate has been rigged. I mean, if you want to look at actually student loans, right, doesn't accurately measure the amount of pain people face. If you want to look at healthcare insurance, right, those rates have significantly gone higher than the 1% or 2% people have been talking about. Just look at your premiums. They probably went up significantly higher than the last year. That being said, if you want to look at the big picture in general, this is a deflationary head fake happening right now. Yes, some of you may not consider it deflation, but that's how these big traders on Wall Street look at it. I mean, they say no inflation, this and that, and also they're saying, hey, a strong dollar index. They're saying, hey, lower oil prices. In the interim, yes, we do see lower oil prices. We do see lower commodity prices. At the end of the day, will this continue to go higher? In the interim, it could. I mean, if you look at the work of Jeff Gundlach, and if you want to look at Raoul Pal, whatever his name is, they're saying that the dollar index is going to go higher. It's in an uptrend. Yes, but at the end of the day, these central planners in Washington, D.C. do not like a dollar index that is too strong. I'll give you an example. If you want to look at this trading view chart from 1985-ish, you could see this huge depreciation of the dollar all the way to 85, 86-ish. And before, the top was like 150 in the mid-1980s. But then Paul Volcker and then individuals in Washington, D.C. said that, hey, the dollar's too strong, we should let it fall in order to benefit our manufacturers. Well, you did see the lower dollar index, but at the end of the day, what ended up happening was Americans lost their purchasing power at the expense of these corporatist manufacturers that felt that a weaker dollar would help their exports. Well, guess where we are right now? 2011. Dollar index is pretty much where it was in the 1980s, late 1980s, and our manufacturing base is showing a huge trade deficit. So it didn't really help. Long story short, I feel that this is a deflationary head fake. You're going to see a lot of people say, hey, let's go long the dollar's on a bull market, right? We could see momentum trading making the dollar index go higher. I do believe at this moment right now it is overcrowded, but you could see more significant strength until Janet Yellen freaks out, and that could be sometime within the next year. And then you could see a huge reversal in the dollar. Mies Shedlock was recently interviewed and stated that, saying that, hey, everyone is bullish on the dollar. It just seems like it's an overcrowded trade. Just like in 2008, he was saying that, hey, you know what? Everyone is bearish on the dollar. You know what? I'm going to go long the dollar. So that's something to think about. Anyways, guys, thanks for listening, and I'll talk to you later. And also leave your comments below. Thanks. Bye.